Welcome to the Deep Dive. Our mission is always to cut through the noise, synthesize the most important nuggets from the latest earnings intelligence, and deliver exactly what you need to know. Today, we are deep diving into BRP Inc., ticker DOO, which is transitioning to DUO soon following their fiscal Q3 2026 earnings call.
And this was the definition of a pivotal quarter. BRP operates in the powersports sector, which, let's be honest, has been grappling with some sluggish demand, high interest rates, and a massive inventory correction post-COVID. Yet somehow BRP managed to deliver figures that were not just ahead of expectations, but dramatically ahead. It really signals a profound shift in their operational narrative.
That shift is exactly what we need to unpack. We are looking at a company that appears to be accelerating while the broader industry environment remains, challenging. Our mission today is to understand the mechanics of that acceleration. Let's start with the headline numbers, because this was a full-spectrum beat that immediately triggered an aggressive market re-rating.
It was a clean slate beat, starting with profitability. Non-GAAP diluted EPS came in at a Canadian $1.59.
$1.59. And the consensus was what?
To put that in perspective, the FactSet consensus was only $1.26. That is a 26% earnings beat, and it represents a massive 33% increase year over year.
That's the sort of upside that demands attention.
Yeah.
And I'm assuming on the top line, they blew past expectations as well.
Absolutely. Revenue hit 2,250.3 million Canadian, up 14% year over year. Consensus estimates were sitting closer to $2.07 billion.
So not even close.
Not even. This wasn't just a few $1 million. This was a substantial outperformance driven by volume and product mix, which we'll get into. And on top of that, normalized EBITDA was strong at $325.6 million, an increase of over 21%.
And the market reaction was instantaneous and, decisive. The stock opened up nearly 8% on the day, right?
It did, and it was trading on 6 to 8 times normal volume. So it wasn't just a bump. The market fundamentally reevaluated the company's trajectory, right then and there.
And that reevaluation was justified.
I think so. They coupled the strong earnings report with another robust figure. The quarter implied a significant free cash flow generation of about $320 million. That really underscores the health of the balance sheet, even as they navigate a soft environment. Strong cash flow in a downturn is always a signal of operational efficiency.
Okay, let's shift gears then and analyze the operational engine driving this success. A beat of this magnitude, especially in a contracting consumer discretionary market, it has to come down to tactical execution and a smart product strategy. So where did the strength originate?
It was entirely a story of mix shift and successful innovation in their core segments. The overwhelming majority of the strength came from the year-round products segment. Revenue there jumped 22.1% to $1.3 billion, making up 56% of their total revenue base. And this was led by higher off-road vehicle ORV volume and, critically, a deliberate shift towards a higher value product mix.
So that's interesting. We've seen other powersports manufacturers struggle to maintain pricing power.
Yeah.
What is it about BRP's portfolio that allows them to push that high-value mix successfully, even with high interest rates deterring so many consumers?
Well, this is where we connect the operational strength directly to the unique demographic they serve. Management specifically noted that the average household income of their customer base is exceptionally high, around $175,000 US.
175, okay.
So what that means is their core customer for premium products is far more insulated from short-term economic tightness than, say, the entry-level consumer. Their whole strategy is to innovate at the high end, and it is absolutely paying off.
So the premium focus is the shield. And we saw the inverse of that happening in their other segment, seasonal products, right?
Precisely. Seasonal products, mainly snowmobiles, saw revenue dip slightly by about 1.6%. But this wasn't a failure of demand. It was a deliberate, disciplined choice by management.
What do you mean by that?
They executed a planned reduction in shipments to right-size network inventory. They chose, a little short-term revenue softness to ensure they cleared the decks and optimized their dealer network health. It prevents a future overstock problem. That discipline speaks volumes about their long-term focus.
Right. Now let's talk margins, because this is where the operational efficiency story truly shines. They reported outstanding gross margin expansion, up 210 basis points to 24.1%. How did they achieve that expansion while dealing with major cost headwinds like the return of variable compensation and, a $90 million impact from tariffs baked into the full year guidance? That seems almost contradictory.
It's a powerful testament to their internal improvements. Management attributed the margin expansion to three specific factors. First, the favorable product mix we just discussed, those premium ORVs. Second, continued pricing discipline. And third, production efficiencies.
Production efficiency, so that's structural.
Exactly. Think of those efficiencies as structural cost savings they've locked in, facility optimization, supply chain stabilization, and better utilization rates in their factories. Those structural gains were significant enough to fully absorb both the variable cost returning and the tariff impacts, leading to a net gain of 210 basis points.
They truly manufactured that margin expansion through execution.
They really did.
That's the definition of controlling what you can control. So digging into the ORV market, which is the heart of their profitability, North American retail sales overall were down 4%. Yet BRP claimed market share gains. How much of that gain is due to genuine product superiority versus, say, aggressive promotional activity?
That's a fair challenge. Their success appears to be heavily weighted towards innovation and product launch timing, not just discounting. While the broader ORV year-round retail segment was flat overall, BRP's retail sales were up low single digits.
Meaning they were actively taking share.
Right. And the star of that show was side-by-side vehicles, or SSVs.
The SSVs.
Absolutely. The SSV segment delivered its strongest Q3 ever at retail, with sales up high single digits. This wasn't subtle growth. This was fueled by their 2026 lineup. They specifically cited the success of new offerings like the high-performance Can-Am Defender HD11 and the launch of the Defender Cab HD10, which is positioned as the most affordable side-by-side equipped with HVAC.
That's clever.
It's very clever product segmentation, offering high utility and comfort at a competitive price point. It attracts consumers even when the macro environment is soft. This focus on launching high-end, high-utility units ensures they capture the wallet share of that affluent $175,000 consumer.
And that operational discipline extends to inventory, which really sets up the next phase of growth.
Yes. They maintained extremely tight inventory control at the dealer level, ending Q3 down 17% compared to last year.
17%.
And 6% below pre-COVID levels. This isn't accidental. This is strategic scarcity. Management explicitly stated they are the best-positioned OEM for an industry rebound.
And why is that?
Because while competitors are forced to dump non-current inventory at promotional prices, BRP has a lean network stocked with current, high-demand, high-margin product.
So we've established they are winning the product and operational battle today. Let's shift focus now to how management is leveraging that discipline to shape the financial picture for the next 2 years. What does this quarter mean for the trajectory?
The raised guidance and the reaffirmed long-term plan are the strongest signals of confidence an executive team can give. They significantly updated their fiscal year 2026 outlook. Normalized diluted EPS was raised substantially to approximately $5 Canadian.
$5. And that's up from what, a range of $4.25 to $4.75?
That's right. That increase alone validated the market's positive reaction. They also tightened their revenue target to approximately $8.3 billion.
And this guidance feeds directly into their ambitious, multi-year strategic blueprint. We keep hearing about the M28 plan. For our listener who might be tracking the numbers but not the acronyms, what exactly is the M28 strategic plan and what specific goals underpin that C $8 EPS target?
So the M28 strategic plan is BRP's roadmap running through fiscal year 2028. It outlines targets of $9.5 billion in revenue and a normalized EPS of $8.
$8.
And achieving that $8 EPS relies on three pillars. First, continued product innovation and mix upgrading, essentially selling more of those higher margin vehicles. Second, maximizing production efficiencies like the margin drivers we just discussed. And third, regaining market share. They're aiming to push their ORV market share back towards 30%.
And this quarter seems to be tangible evidence that they're on track.
It's the first real tangible evidence that they are successfully executing the early phases of this plan.
Now let's look at how they plan to amplify those earnings for shareholders. The company made a major commitment to capital return with the normal course issuer bid. basic and technical language for our audience. What exactly is a normal course issuer bid, or NCIB, and how does repurchasing 10% of the float translate to maximum per share torque?
An NCIB is simply the legal authorization for a company to buy back its own shares from the open market. In BRP's case, they authorized the repurchase of up to 3.13 million shares over the next 12 months, which is roughly 10% of the public float.
10%, that's aggressive.
Very. The per share torque comes from simple math. If you generate, say, $100 million in net income and you reduce the number of shares outstanding by 10%, that net income is now spread over fewer shares, immediately boosting the earnings per share metric.
It's an accelerant.
It is. It's an effective way to leverage operational improvements and signal to the market that management views the stock as undervalued. And this, coupled with their debt restructuring move saving $30 million a year starting in FY27, underscores a comprehensive commitment to shareholder returns.
That's a strong capital allocation strategy.
Right.
However, management also maintained a balanced view on the current environment, noting that we aren't out of the woods yet regarding macro headwinds.
They maintained that essential credibility. They acknowledge that high interest rates continue to suppress retail demand, especially for those entry-level, non-affluent consumers.
Right.
Citing the Riker three-wheel vehicle as an example of softness. They expect the competitive promotional environment driven by the non-current inventory of competitors to persist for a few more quarters. Their base case for calendar 2026 industry retail sales remains flat, a key input showing they aren't relying on a macro rebound to hit their numbers.
This brings us to the biggest financial insight of the call, the structural tailwind coming in fiscal year 2027. That alignment effect is forecasted to provide a massive boost that is almost guaranteed, regardless of the macro environment.
This is the engine of the next fiscal year's story, and it's crucial to understand why it's so powerful. Think of the dealer pipeline as a water hose. For the last year, BRP was selling product at retail, water was coming out the end, but they were deliberately restricting the wholesale shipments into the dealer network to shrink the pipeline.
They are destocking.
Exactly. That structural destock depressed their reported revenue and EPS.
And now that destock phase is effectively over.
It is. So when that shrinking stops, their wholesale shipments suddenly get a massive one-time boost equal to the difference they had previously withheld. Management quantified this shift. The simple effect of aligning wholesale shipments with retail demand is expected to provide a tailwind of $400 to $500 million in revenue.
$400 to $500 million, just from turning the hose back onto a normal flow?
Precisely. And this translates directly to roughly $1.25 in EPS lift, just from the return to normal wholesale shipment levels.
Let's put that $1.25 figure into perspective for the listener.
If you take their newly raised FY26 EPS base of $5, that $1.25 tailwind represents a structural organic lift of 25%.
25%.
Before any other growth from new products, market share gains, or macro recovery. When you calculate their overall base case for next year's EPS growth, it sits comfortably in the mid to high teen percentages, driven primarily by this structural inventory correction ending.
It's a guaranteed increase that the market appears to be slow to fully price in.
I believe so.
That structural tailwind, combined with the aggressive share buyback and the ongoing premium product cycle, creates the very specific setup for the future. And just a reminder for you, the NASDAQ ticker symbol is changing from DUO to DO effective December 8th, 2025. We transition now to our segment, This is Not Financial Advice, where we consider a provocative, high-conviction trade idea based purely on the specific quantitative and strategic signals we've extracted from this deep dive.
The thesis remains solid. BRP is fundamentally shifting from a repair narrative fixing inventory and supply chains to a full-fledged offense narrative. We have market share gains, clear product momentum, volume leverage potential. I mean, their factory utilization rate is only at 65% now, and it's expected to rise.
Yeah, big buyback.
And a commitment to aggressively reduce the float via the NCIB. And that M28 target of $8 EPS provides a powerful multi-year ceiling.
So how do we best leverage the certainty of that $C$25 structural tailwind and the ambition of the C$8 target?
The outrageous but plausible trade is to gain long-dated leveraged exposure via call options, often called EPS, time to expire near the fiscal year 2028 target. The trade is predicated on maximizing the per-share torque. We assume they successfully execute on the 10% share repurchase program and fully capitalize on that massive $1.25 EPS lift arriving in FY27.
You're betting on the float reduction multiplying the earnings growth.
Exactly. If they achieve even the low end of that FY27 mid to high teens EPS growth target and aggressively shrink the share count via the NCIB, the per-share earnings growth will see maximum acceleration. We are confident the market is still materially underpricing the certainty of the FY27 wholesale alignment tailwind. This stock is already proven as a high beta winner, and this setup provides a pathway to significant upside if the operational execution continues.
We've covered a quarter that delivered on all fronts, a significant beat on revenue and earnings, impressive margin performance driven by favorable product mix and efficiency, and clear market share gains in the critical ORV segment, highlighted by the strongest side-by-side quarter ever.
The path forward is clearly defined by the significantly raised FY26 guidance, the robust commitment to the 10% NCIB share buyback, and the reaffirmed M28 target of $8 EPS. This confirms their strategic pivot is succeeding even in a difficult environment.
Before we leave you with a final thought, remember, this discussion is for informational purposes only. It is not financial advice. Investing carries risk, and you should always conduct your own diligence.
We noted earlier that BRP's current success is highly reliant on its affluent customer base, those consumers with an average household income of $175,000. They're the ones willing to buy high-end, innovative products like the Defender Cav HD10. This demographic provided a layer of resilience this quarter. The question for you to mull over is this. Management is driving growth through premium innovation, but how long can BRP rely on the affluent consumer to shield it from broader interest rate pressures if general economic tightening eventually impacts even that upper demographic? Is their premium focus a lasting fortress or just a temporary shield against the macro storm?